Good evening, everyone. Thank you for joining us on this webinar where we decode Union Budget 2024 with a bit of a focus on the real estate sector. When we planned this webinar, we were expecting a lot of changes devoted to the real estate sector, but it seems like all the conversation is now getting centered around this one aspect of the indexation benefit being withdrawn for capital gains on sale of properties. But obviously, there's a lot more than just that one change. There are a lot of policy level announcements. Some of them find the way into the finance bill. Some of them reflect the intent of the government to make changes in the coming months as they unravel more policies. So the idea of the next 60 minutes would be to bring all of you as experts. And we've chosen the panel very carefully because each of you represent a very diverse segment within the real estate industry. So what I'm going to do is I'm just going to welcome each of you and then request you to sort of start with your overall comments on the budget and then maybe jump into a specific question. Let me start with you, Karan. Karan, thank you for joining. As I'm sure everybody knows, Karan is the CEO at WeWork India. So Karan, would love to get your opening thoughts on the budget, please.
Oh, Abhishek, thank you. Thank you for having me. Um, I would sort of like categorize it or like maybe look at it as a view of someone operating, a business and maybe reflecting the country, in a similar fashion of like a, extremely large business that when things are maybe going right and going well and all of the metrics are kind of, moving in the right direction, that you shouldn't really do too much. And we were just I guess discussing briefly before this started that maybe sometimes just doing simple things is what is needed. And I look at it just with that view that today if I was like maybe operating a business of a similar fashion, I wouldn't want to change too much, but maybe correct some of the historical flaws that are there when it comes to policy and ease of doing business and things like that. So I think from our perspective, obviously the capital gains issue from a real estate perspective is a problem. One of the things I think that was great was the abolishment of the angel tax, which was, a huge boost, at least for the startup ecosystem, and to bring, I think, funding back, a little bit of liquidity back and a little bit of interest back into that segment. But yeah, just general thoughts are, keeping things steady, getting everything moving, and exactly what maybe we needed at this point in time.
Oh, nice, Karan. And while everyone now calls it angel tax, I will venture to say that the removal of that tax will actually help real estate transactions and structures more than anything else. So, it's not something limited to startups. So I think that's a really, really big one. Just staying with you, Karan, and pulling you into the whole GCC narrative. I think notwithstanding what everyone had predicted in the midst of COVID and maybe a little bit after that, that the flow of GCCs to India will slow down. That's actually turned out to be one of the biggest growth engines driving commercial real estate, and I'm sure driving to a large extent your business as well. And this announcement of creating of these industrial parks and the plug and play kind of approach. Just
Mhm.
your perspectives on, is enough being done to spur the growth of GCCs, and is there anything more you'd like to see the government do both on the tax and policy side?
I think that, from a GCC perspective, it's clear the real attraction, continues to be talent, more than the government trying to, subsidize or having policies around it. It is really just the access of massive talent that these companies are really going after. And, India continues to be the hub for that in the world. So regardless of, what they've issued or what they plan to issue, I think that's still going to always continue to be the reason why GCC growth happens. I think today the government doesn't have a central view of how to, look at this. It is like very state driven, and I was part of actually a few discussions at least at the Karnataka level, and it looks like, it's just about one-upping the other state in terms of what you can do to bring GCCs in. And, like I guess Hyderabad or Andhra being a threat to the Karnataka sort of like office market, or at least what the government views as the next location that they're losing a lot of GCCs to. So I don't think enough is done. I think that they're still kind of figuring it out. There's no real central approach to trying to attract GCCs into the country, and I think that they're organically coming because the talent is here, and the talent is going to continue to be here for a while.
Sure. No, thanks. Gauri, thanks for joining. Just as a quick introduction, Gauri Shankar is the CEO designate of Capitaland India Trust. You've worn several hats, very, very interesting and big ones over the last decade or so. Just wanted to bring in your experience from an infra perspective. Infra finds its way in every budget. Sometimes it's just lip service, sometimes it's real. What's your own view on how much attention the government's really given to infrastructure, particularly to data center and logistics? And were you expecting something more specific around both policy and tax for data centers?
I think the direction that the government has taken in terms of infrastructure has been quite consistent, and it's just not lip service. But if you look at the logistics sector, which I was involved in for about 5-6 years, it definitely benefited out of the noise around Make in India, the Pillai scheme, the improved road network, the GST. So a lot of action has happened, and the industry has benefited significantly. So directionally, whenever the government does make noise, it seems to follow up with actual policy which has actual impact. Notwithstanding, what happened around us also kind of helped with all the geopolitics around India. Kind of became the oasis for all the the ones that wanted to get out of China. So we became part of Asia. Till then, we were not part of Asia. No, Asia was China. India became part of Asia only over the last 3 to 4 years, 3 years, I would say. But yeah, that's something which we'll have to watch out for. I mean, even for us, no, I mean, our own portfolios in the industrial sector are doing really good. We raised about a couple of 2 funds, about $400 million each. A third fund is expected. They're showing brilliant returns, and I think that.
Sorry, I think. Okay, seems like Gauri just got cut off. Lata, if I can welcome you. Lata Pillai, thank you for joining us. Lata is a senior MD in the capital markets practice of JLL. Lata, your perspectives overall on the budget, and then I'm going to bring you in to share views on whether there's enough being done on making credit available to the real estate sector.
In fact, I echo the thoughts of both Karan as well as Gauri on this one. I guess directionally, there doesn't seem to be the change. I think the government, as budget should be, is focusing on the larger stuff as a growing economy. And I think the impetus on agriculture, on infrastructure, on education and skilling, I think all of it is directionally very positive and will have effects in our sector as well. Cannot remain untouched, right? So in that sense, it's definitely a positive. Now, a specific mention on availability of credit. I think credit, especially to the real estate sector, is really lacking. Okay, there are, and I don't think much steps have been taken to improve that. If anything, I think the credit that's available is available to a few groups of developers or investors. The mid segment of it really do not get the credit that they should, because primarily credit is being done by the banking sector and it is heavily regulated. And I think one area that was opening up was your AIFs and through the debenture structures. And I think the tax, the cap gains that have been given on debentures is going to make that expensive as well. So I think on the credit side, I think more could have got done in this budget.
Sure. Thanks, Lata. I'll just take this opportunity to welcome Amit. Amit Saraf, thank you for joining us. Amit is the CFO at Godrej Funds. Amit, would love to get your opening thoughts on the budget, and then I'll come back to you with a specific question.
Thanks, Abhishek. On the budget, I think it's been a mixed bag for me. If you see on the economic front, the economic survey kind of projected a GDP growth rate of 6.5 to 7% for FY 24-25. And if you see over the medium term, they are still projecting over 7%. This was lower than all the estimates and sharply down than 8.2% growth of last year. And mind you, if you grow at this rate over the medium term, it will be much difficult for us to achieve our long-term vision of being developed nation by 2047. I think what stand out for me this budget was the fiscal consolidation. The finance minister did a great job to reach aiming to reach a fiscal deficit of 4.5% by next year. And this year the target has been 4.9% as against 5.1% which he picked, which was a part of the interim budget. However, one should actually note that this fiscal deficit was lower primarily on account of the RBI dividend, which was one-off item. And I think she was prudent to not increase spending, clearly recognizing the one-off nature of this RBI dividend. On the budget front, I think there have been one big positive and one negative for me. On the positive side, I think we just spoke about the abolition of the angel tax. This will make all our lives easier because this was one provision which was creating huge amount of issues. We had to marry valuations across various statutes, be it FEMA, Companies Act, income tax, and it was creating a lot of issues for us. And the biggest negative for me, which came as a big surprise, was the buyback tax in the hands of the shareholder. The proposal talks about the entire buyback distribution to be taxed as deemed dividend. I think this will have a major impact on the resident investors as compared to offshore investors, because offshore investors can still kind of go back and claim treaty benefits. But this effectively has killed one of the other options to extract money from the companies and have a significant impact on SPV structures, which is very common in our real estate space. So overall, I think it's a mixed bag for me.
Thanks, Amit. Just coming to a specific question that I wanted to ask you in terms of investor interest. I know you all represent and attract a lot of large international investors bringing their capital into Indian markets. But if we look back, say, a decade or even longer, the number of large investors in the Indian real estate market has kind of stayed flat, right? What, according to you, are the reasons for sort of this negativity, if you will? And does this budget in any way seek to commence dispelling that negativity and opening it up to more international capital?
So if you look back, like say in early 2000s, the real estate segment was very, very unorganized, and there was very limited option for institutional investors to have a play here. But I think what changed the key change was, in my view, was the release of Trust Note 2 of 2005, which permitted 100% FDI under automatic route, and which I think led a lot of institutional investors to consider real estate as really an attractive investment class for it. Additionally, I think with the introduction of like RERAs, the establishment of REITs and relaxations under FDI regulations, it provided a more liquid way for them to kind of participate into the Indian real estate market. But you're right to say that, yes, the participation has not grown significantly. I think if you see till 2016, there has been an increase, and it was predominantly towards residential segment. But since 2016, the focus kind of moved towards office space, industrial warehousing, your retail sector. But that again was short-lived because then COVID hit in 2019, and then further you had all this global geopolitical issues such as Russia-Ukraine wars kind of thing. To specifically answer what's holding back now the institutional investors to enter Indian real estate market, I think it's more to do with some of the global factors as well. Now, if you see the global office portfolio valuations are down anywhere between 10 to 50%. And when we speak to these investors, they are finding much more risk-adjusted returns in global markets as compared to India. So the question is, why India? Having said this, I think there are a lot of factors in India which obviously can influence these decisions. Like you have more regularity, landscape being more friendly. Availability of land is a big issue with clear titles. Development related issues like your approvals, labor issues, all of that are like big issues for these investors. Somewhere I think this budget did a bit about changing that perception. Like fiscal consolidation was one big thing, I think, which will be looked positively by these investors. Plus, initiatives on taking digitization of land records, lowering of stamp duty. Simply, they have talked about simplification of FDI regulations and introduction of VCC structures. I think some of the initiatives, if kind of implemented, I think we should see a larger participation from institutional investors.
Yeah, I hope that plays out, Amit, as you're outlining. Gauri, thanks. Welcome back. I thought we had a crowd strike moment when you dropped off, but
no, sorry, it's late evening in Singapore and IT was running a patch. I think they've forced restart. Sorry about that.
no, not at all. So yeah, if you could continue, you were talking about.
Yeah, so like I was saying, I mean, I think there's a lot of the policy changes that have helped industrial real estate and also the digitization that happened in India and the power reforms that happened really helped us get our footing on the data center front. So to the specific question of what has been done in this budget, I think it's more indirect than direct. As such, we didn't have too much expectations from this one, specifically to this asset class. But what is definitely going to help is, I think, if you talk about data center, is essentially a power game. I mean, India, just to give an example, for you to get a power allocation in India, depending on which state you are in, could be a 3 months to a 9-month process. But India is sort of in a power surplus in most places. So you would get a power allocation. Let's take the example of Japan. It takes about 6 to 7 years to get a power allocation. So India, from that front, for data centers is become very, very attractive. And for somebody to set up their shop here and to service, the what do you call as the digital public infrastructure that the government is doing, be it the Aadhars, the UPI or the ONDC, etc. I think all of these are definitely giving a lot of fill-up to this sector. It will continue to do so, is my sense. But on moving back to the logistics side, I think it's been a great run so far. Most of the funds that have invested have shown great returns, be it domestic funds or international funds. But one thing does sort of gives me a bit of a scare. It's essentially the US elections. I think under Biden, there wasn't, this confrontation with China was a lot less. So localization into the US was a lot less. Today, when we talk to a lot of the Asian manufacturers who are looking at a China plus one model, who are coming to India over the last 2 to 3 months, are kind of taking a little bit more time. They want to wait till the election results are out, and they are worried that if the Republicans win, especially if Trump comes back, he may actually say that he may put a lot of roadblocks for them if they are having manufacturing facilities outside of the US. So they just want to wait and watch, and that could be one bit of a dampener, which can sort of have an impact on logistics in the medium term.
So thanks, Gauri. Sanjay, welcome.
Abhishek, my apologies. I was engaged in something which I couldn't step out. I was on a stage. I couldn't step down. Sorry about that.
No problem at all, Sanjay. Thanks for joining. And since you're there, welcome again. And maybe I'll just bring you right in. Although if you want 2-3 minutes to sort of walk into an office, etc., no problem. Please feel free to do
that. Is this too much external noise?
No, there's no noise at all. But
okay. No, I'm okay. I don't want to miss the opportunity. So please go ahead.
Great. No, just would love to get your opening thoughts, Sanjay, on the budget, and then I have a specific question for you, but just your overall comments on the budget.
Yeah. So, I've always felt that this government has a very decisive, stand on anything that they have thought through. And, this is after a very long time that the government has stepped into a third term. So the reason I'm saying these things is because India never had consistencies in terms of vision, policies, and tactical implementation of those policies. And to be in this situation, itself is a big thing for this country. Second, there was a time when governments were of coalitions mostly, and times were very uncertain. While this year there have been some headwinds, but I think not significantly impacted the political climate of the country. And in this budget, they've abundantly taken care of the two states which they are supporting. And the states which are coming for elections, they're on a good path. Having lost some seats in the recent elections, the government is also conscious of what they need to do to come back with majority over the next 3 to 5 years. So there is again a mindset. Now, having said all of that, more specific to the budget, I think they are continuing to do what worked for them. So the infrastructure story continues. The affordable housing scheme continues. The urban story continues. The addition to our economy is the manufacturing, the 12 industrial corridors, which I think is a great news for this country, because we were so over dependent on the services sector, which was leading to concentration of the economy in just fewer states and cities, which happens to be the case, by the way, in many global markets. So, France economy, 90% would be Paris, and UK's 60% would be London. But their population base is not that much. But for a country of our size, and the kind of jobs that are required and at various level, we need to have alternate strategies. So manufacturing, it's a big advantage I see, and the thrust that I see is a good welcome addition. I think the media in general is obviously talking about the capital gains, which I'm sure we have abundantly discussed already. It's a pity that it has come at a stage when the inflation is high. And I understand that it is the duty of the government to send a strong signal that they don't want speculation, whether in equity markets or whether in real estate market. Fine, but I think there were different ways of addressing it. It is slightly disruptive for the sector, which is already under a lot of stress and pressure. The entire budget, Abhishek, from my point of view, is demand-led. So if the economy does well, if the GDP remains, if the fiscal discipline remains, if the inflation is under control, everybody will benefit. There'll be momentum, there will be job, there will be investment, and therefore the story will go on. But when it comes to real estate, I think they need to really step out of this affordable angle. It's something which at one time they did emphasize a lot of ease of doing business. They haven't done much at all in that space. Their intentions are genuine, and simplification of taxes and all of those to some extent point in the ease of direction. But the ground reality for the real estate sector is extremely shocking. I recently posted, on my LinkedIn page, unshackle real estate as a theme. And the reason I did that, because just the cost of doing business is just high. The uncertainty around certain geographies and the political vested interest, which is another problem that we face in the real estate sector, are major deterrents. And somehow most governments have failed to notice that unless they make real estate sector with ease to move faster, they're easily missing out on at least 1% of the GDP. If they just add ease of doing business, I know that was not the mandate and the scope of the finance minister, Abhishek, I get that. But I think there was an opportunity for them to do something on those lines and convey, they all want private capital to go up in this country. The only way the private capital will go up in this country is when people in the private capital thrives and does business. without fear and concern. So I think that is what my take is, the initial thought is on the budget. Uh,
Oh,
I
thanks,
believe
Sanjay.
I believe real estate will do well this year. This will be the highest, the best year so far in real estate. We have the highest office absorption, maximum number of residential sale. There's enough cash flow amongst developers. The lenders are happy. And many of the NCLT distress is getting weeded out of the system. So it's all good news so far. But what lies ahead 3 to 4 years, Abhishek, worries me.
No, as always, eloquent and detailed, Sanjay, but it's a great segue to bring Kailash in. Kailash, welcome. Kailash, for some of you who may not know, is the deputy editor at the Economic Times. And Kailash, well, I would love to get your overall perspective, maybe just jumping into what Sanjay said on the capital gains change, particularly for residential property. Was it done to arrest the overheated market in some cities, or was there some other angle? And I'm sure you've been in the thick of this debate ever since the budget was announced. So would love to get your perspectives, Kailash.
Thanks, Abhishek. With this long-term capital gain tax and indexation benefit that's going out, a lot of people are worried that the investments that have happened, although they clarified it later on that 2000 property values until 2001 have been grandfathered. So, but since 2001, or for that matter, even 2012, 2014 onwards, particularly, prices have gone up. And like Sanjay said, this benefit going out at a time when inflation is high, prices have gone up. This may result in certain, investors getting that heartburn. And going forward also, I mean, although the government is saying that you have the way out to invest the same amount or the same funds in the other properties that you want to buy, that way the investors' money will keep rotating in real estate sector itself. They won't be able to get an exit, and most of the investors, as an end user, that's a good thing. But for somebody who's an investor, they would look for an exit with superior returns. And if your returns are getting eaten into by a move like this, it's a cause of concern. And somebody who has already invested, exit is an issue. But somebody who has money and who wants to invest now on, at least will have a thorough thought process before he or she actually does so.
Thanks, Kailash, and I'm sure we'll get some perspectives on this from the other panelists as well. Arpit, welcome. Thank you for joining us. Arpit is a MD at Xander Investment Management. Arpit, your opening comments, and I think if I can specifically ask you, how are people outside India perceiving the budget? You represent a lot of marquee investors whose funds you manage and interact with them. So, what's the view from the other side of the seas?
Thanks, Abhishek. And I think a lot of very knowledgeable comments and inputs already provided by fellow panel members. Just my quick, summary on the budget would be, I feel in sync with some of the comments made. I feel it's more of a budget coming from a secure position that the government seems to feel that itself they are in right now. Is the third term. Sanjay made a valid comment, hasn't been seen in recent times. Frequently, it's a non-coalition government. I think some of that is getting conveyed, that their policies and their changes are have mostly been medium to long term, which is good to see. And even after the recent election results, which didn't go exactly as was at least being projected in the media, they haven't changed that approach, seems to continue on consolidation. And I think generally because of that, I feel positive about the way that the policy making is currently happening across streams. I think the key aspects, Lata rightly mentioned, the skill part, right? That's a long-term investment. That's an investment that is made today and it will start bearing results in some shape and form a few years down the line. Accordingly, the continued push on infrastructure, manufacturing, which will lead to thereafter, benefits on industrial, logistics, data centers, and related investments, which are all kind of in the right direction. Obviously, while they do all of this, they keep on I think Karan initially mentioned, keep on fine-tuning what they're doing rather than making major changes. And I think some of that translates to continuously we've seen, not today, but over the last few years as well, some of the changes that they keep on making to tax and structuring related aspects. So I would say that one part sometimes leads to some surprises from an investor standpoint. Now the capital gains change is one of them. Jurisdictional changes have happened in the past along the way, GAR related changes. So tax related changes, some of them coming surprisingly along the way, something which everybody is not able to at least put a finger on from a foreign investor standpoint, that what is the end game. Like in this budget, there was this point about increasing the tax on debentures, especially for foreign owned debentures to 35%, which was earlier significantly lower. So with that being the case, why would that be required? Because that's actually a large source of capital as well through debt. I think 60 to 70% investment in the money markets happen via debt and bonds. So why, and especially as Lata highlighted, right, debt is a bit of an issue right now, especially for real estate, and has been. So maybe there are some reasons. Sometimes I feel the government and the team over there is quite smart as we've seen in a long time. So there may be reasons which are not very evident or clear for which something is being done. But feel that if some of those things could be, even if changes are needing to be made, could be better explained from a thought process standpoint, would make things more clear to people outside who are looking at India as a major investment destination. That would be my ask on some of these material changes going forward, but otherwise generally feel positive.
Yeah, and Arpit, just very quickly, real estate has remained one of those sectors in the FDI policy with still lots of ifs and buts and lock-ins and restrictions and all of that. Given that it's now matured, given that we've seen capital come in, create assets, capital go out, just a quick perspective on, is it time and were we expecting some easing there?
Yeah, I think I would just feel that I think the capital flows in and out of real estate, I would say, especially from on the private side, leaving the public markets and the REITs and the InvITs out for a little bit, have generally been medium to long term, I would feel. I don't think that we've seen generally a wave of capital which has come in and gone out in a very short span of time based on a domestic or a global event. I don't think we've seen that all the way back. If you go back, you need to say 2008 maybe, right? At which point of time, a lot of investors said that, we're going to pull out our capital, etc., and that should, troubling the government. Given that is not the case, easing some of these things will kind of make investments easier. One of the questions previously highlighted, why does private capital not flow if the macros are so good and, India stands out? I think one of the key reasons, ease of doing business, Sanjay mentioned, it is a real point. And especially for people like ourselves who are in the investment, business, we can tell you it's very difficult, right? And we struggle with it on a regular basis. To get money in, structuring anything is quite difficult. To get money out and exit, even more difficult. Now there's buyback tax, Amit mentioned. So even more expensive. So I think some of these things, if they can be simplified, again, ain't going to be a short-term fix, but the medium-term fix would only help the capital flows. And I don't think the capital flows at this point of time, Abhishek, are very, very fluid, that they go in and out in 3 months, 6 months windows. I think anybody who invests with a 3 to 5 year mindset in real estate. Enabling some of these things to happen will only benefit, but maybe that conveying some of that job lies with people like ourselves, of explaining the requirement and how it will benefit, and potentially representing the industry on it via CredI or through other institutions is something that we should do. Will definitely help.
Sure.
And I think ease of doing business in real estate for investors would be maybe paramount request for capital flows in the future.
No, thanks for the candor, Arpit. Gautam, thanks for waiting patiently. Just to quickly introduce you, Gautam Hora, Managing Director at Edelweiss Alternatives. Gautam, you've been sort of tracking the core yielding asset class for a very long time. And with now a large number of new fund managers seeking to raise fairly large pools to acquire these kind of assets, both domestically as well as international investors. Just curious on your perspective on how do you see fund managers anchoring deals, and how do you navigate the demand supply aspect when you go after these core assets?
So Abhishek, thanks for the question. I think in terms of the demand and supply and how managers are navigating it, the supply now for Indian office sector is quite large, and Indian office market is quite deep and mature. With today Grade A office being 800 million square feet, on an overall basis, and this is expected to increase to 1 billion square feet over the next 2-3 years. So I think there is enough and more, from a supply standpoint, availability of Grade A office for various types of investors, whether they are international or domestic, to pick up, create their own strategy, and kind of do their investments across. So I don't think that supply is a problem. I think there's enough and more supply. What also happens is that with this kind of a stock available in the market, there is constant churning, there's constant transactions happening, sale and purchase of assets, portfolios is happening now. So I think from that perspective, office assets have been traded since 2010, if not earlier. So, we've seen now a 10+ year track record of investors investing and then stabilizing and then exiting. From a demand side, obviously this sector has been dominated by the foreign investors, right? So we've seen the Blackstones, the Brookfields, the GICs of the world having made billions of dollars of investment in the core office market. And because they've invested over the last 10-15 years, we've also seen now a pretty long track record of them investing, divesting, and making pretty decent returns in this asset class. And some of them have also actually very carefully created and curated portfolios and then successfully listed them in the form of REITs, and in the process made supernormal returns. I think what's changing now in the last few years is that this has come into the eyes of the domestic investors as well. Domestic managers are giving opportunities to domestic LPs to participate in a very similar pre-REIT kind of a strategy, where, instead of only foreign investors playing in the market, domestic investors are also raising significant amount of capital, and creating that, pre-REIT kind of a story, where they can go ahead, kind of agglomerate a portfolio of office assets and then kind of, ultimately exit in the form of a REIT or a portfolio exit. So I think that's the change that we are seeing. And domestic LPs, again, have seen the track record of the international LPs making money, are quite excited about this strategy. And from an actual deployment perspective, I think, again, the market has become mature enough. There is core plus in the market, which basically means buying absolutely new buildings. There's core minus strategy, which is nothing but value add. You buy older office and fix whatever is wrong, whether it is in the form of refurbishment, repositioning. You have financial value add that people do. You've got forward purchase, which has come up in a very big way in the last few years, where investors are taking selective leasing risk, selective development risk, joining hands with developers who are executing projects, and it's a win-win situation where the seller gets a higher value and the buyer also gets a better cap rate. So I think the market on the office side has become much more mature, and deep, both from a supply and demand perspective.
No, thanks for that, Gautam. And just, since you talked about REITs being a sort of natural extension to where a lot of the funds would move their portfolios into, what's your perspective? How important was the change in the holding period for REIT units being brought down to 12 months, for there to be long-term capital gains from being 36 months all this while?
No, absolutely. That's a welcome change, Abhishek, and that shows the intent of the government to now kind of make these exit vehicles, as investor friendly as possible. So I think that's definitely a welcome change. Another welcome change that at least I've seen, and of course all the panelists have spoken a lot about everything which has been announced in the budget. But another point that I would like to add is that, based on the time period of definition of long-term capital gains and the rates, at least I noticed the intent of the government to create a level playing field between foreign investors and domestic investors, which I think is a positive outlook. The government doesn't want to continue to give benefits to international investors. Of course, there is this point about the international investors continuing to get benefit of forex fluctuation, which I don't know whether it's a miss or it's an actual benefit. We can see that in the detail as coming out. But I think the overall intent seems to be creating a level playing field, which I think it's quite welcoming.
Absolutely, Gautam. That was an ask for years and years, on the private side particularly, that why should a foreign investor get away with a lower rate of capital gains tax? So I think that's a very important change. Thanks for highlighting that. Amit, saving somewhat the best and the more details for the last. What are your sort of, apart from whatever we've already covered in terms of capital gains, property, REIT units, parity for non-resident and residents, what are the 2 or 3 other tax-related changes that you think we should all be talking about between now and the budget being finalized?
Yeah. So one thing, most of the funding into real estate happens to come through CCDs, unlisted NCDs, etc. Now, by mandatorily treating them as short-term assets, that been a little bit of a dampener, because overall all these instruments are quite efficient to sort of take the returns and basically repatriate it. And earlier, historically, there was no indexation benefit available for debentures. But treating all of these instruments as short-term, irrespective of the period of holding, that seems a little bit of a dampener. On the positive side, while 12.5% has been introduced without indexation, the way I am looking at it is now it's a level playing field vis-a-vis listed shares also, so that this asset class will open up quite a bit, because so far it was about 10% versus 20% tax rate. So there was no real reason for any investor to sort of look at real estate in a true sense. Now with this delta coming in, going away rather, for people who have put money in the past, this indexation not being there hurts. But at least now, as long as it is on par with listed securities, my sense there could be more of this fractional pooling vehicles coming in beyond this MSM REIT also, which will ultimately sort of move into a REIT, listed REIT scenario. So that would be my take on it. And of course, buyback tax, hopefully something will change over a period of time before the act comes out.
Thanks, Amit. I'm just going to come back to each of you with a question and maybe request a quick 30-second, 60-second response on that. Amit, I'll just start with you on GST. This has been a big bane for a lot of time, where the GST input on commercial assets is not allowed to be carried forward and set off against the output when the leasing commences. And year after year, this remains unaddressed. How critical is this, and what's your own sense of why this is stuck?
So honestly, as you have rightly pointed out, this has been the biggest task for the office industry for a long time. And the basic principle of GST is that there should not be a cascading effect on taxes. And very strangely, when a developer kind of builds to lease, the credit is not allowed. Whereas if he's building to sell, the credit is allowed. And this creates a symmetry between the tax treatments, while both the revenues, like from sale of your units or from leasing of the units, both equally attract GST. What it does, basically, it in fact increases the cost in the hands of us, developers like us. And we have done some internal estimates. It could range the IRR impact could range anywhere between 50 to 75 bips kind of a thing. Now, allowing this credit, in fact, will basically allow us to pass on some of the benefits in terms of rental, which will in effect have a big impact on some of the rate sensitive segments, like for example MSMEs. So I think that is something which is a miss for a long time. And if you really see the impact to the government, we did some number crunching. The loss to maybe the government was over the last 7 years, I think there is around about a 1 lakh crore of accumulated credit, which is still not allowed by the government, and which is even less than one month's GST revenue. And if you extrapolate that, it would be even less than like 1% of the monthly GST. So I think not allowing this credit for office segment is kind of defying the whole objective of GST being a complete pass-through. So I think this is really impacting the segment big time.
Karan, just coming to you and maybe wearing both your WeWork and Embassy hat, is there still, are grade A developers really going into tier 2, or there's still so much untapped opportunity in the tier 1 that no one's really focusing on the tier 2 cities?
I think from a grade A perspective, both commercial, players or developers, still not really venturing into tier 2 markets. I think there will be one or two cities, or maybe pockets like Gift City, etc., which might see some action where there is some sort of inorganic drive for demand, or certain companies asking for maybe a build to suit requirement in some of these locations, which might drive a developer, a grade A developer, to at least set up some space there. But I think speculative demand is still continues to be within the top 7-8 metro cities where 80-90% of the leasing happens. And I think from a flex perspective also, at least as a mid to premium player in the market, our focus also continues to be in the top 7-8 cities where we see high quality demand continuing to drive most of the leasing activity. However, I think in our segment, or at least the flex segment, because there's such a wide spectrum of operators, similar to maybe hotels or hospitals, there is enough and more demand in the tier 2 cities for some of these operators to actually scale and have decent size operations, I think, over the next few years. I would say that most people are looking for maturity to develop within these markets before entering. And that means, maturity of social infrastructure and schools and things like that, where talent will actually be happy to stay over a long period of time. That continues to be the driving factor, in my opinion.
Gauri, just taking a segue on what Karan mentioned on Gift, right? If you look maybe 2 decades back, it was said that if you need to do a REIT, you need to do it in Singapore, and then we had REITs in India, and then everyone said if you need a private equity pool of capital, you need to do it in Singapore, and then now we have funds in India. So, do you think now Gift is a viable alternative for all kinds of international managers to really create their base?
Yeah, definitely. We ourselves, we have been operating fully out of Singapore. Usually the typical debt instruments, we used to raise debt in Singapore, hedge it, send it to India through debt instruments and repatriate it. But I think the government has been sort of closing a lot of those optionalities or benefits that were there. So right now we ourselves are looking to set up shop in Gift. I think the benefits are, you have the withholding tax on debt repatriation is low. Not just that, I think the biggest impact is you don't get covered by the thin cap rule, and plus everywhere else the cost of debt has gone up. So for any foreign investor to not see value in Gift is kind of becoming quite a challenge. I think with Gift City also sort of figuring out the rules, and I think even the recent budget, there are certain benefits such as your variable corporate company structure, which could actually open up a lot of avenues for investors such as us who don't play in the domestic market in terms of raising capital, but from a structuring perspective, it gives a lot of optionality to set up shop there. So definitely, I would say yes. It gives a very, very viable option. Just that no alcohol is served, so that's a dampener. But otherwise, I think Gift City does play a significant role. But yeah, the one challenge I do have is they have a lot of. You need to show presence, and the rules are quite stringent as compared to Singapore. Singapore presence is usually shown in terms of cost, but here it is actually expected to be shown in terms of personnel. And to find talent to move from Mumbai to Ahmedabad is still a bit of a challenge. Maybe that's something which they need to work on if they want to attract more institution to set up shop there.
I wonder why you didn't mention Bangalore, Gauri, but I'll pick that separately with you. Lata, just coming from a capital markets perspective, we've seen a lot of REIT offerings. Those continue to come about. When will we see the next real estate IPO?
I guess quite a few of them are readying themselves for it, I guess, given some of the successes that have happened. And I think one thing which I should say, I don't know whether this is, but I guess on one hand, removing the indexation benefit on cap gains, and the other hand, lowering the holding period for REITs. I think directionally, I think the government is wanting more participation of retail in REITs. And I think that will lead to more institutionalization of commercial assets holdings, right? So I think that probably is a direction that it's headed. And therefore, I'm quite sure that we will see more REITs. And definitely, and I think on the real estate IPO side, I think given most of the guys who've been in the residential space have seen a fabulous run on residential side. So I think the monies have been coming, and it has been a good run that they've been having. Having said that, there are quite a few of them who are getting themselves ready for an IPO, and we may see quite a few of them probably later this year and early next year. I think that.
Yeah. I'm just reading between the smiles when you said a lot of them are ready for IPOs. I saw Sanjay smiling. So Sanjay, would love to get your perspective on the next real estate IPOs, and also your perspective on just the whole fractional push within real estate. With the government introducing the SM REITs, how much of an impetus will smaller assets get through the smaller REIT platform?
No, it's a great question, and I think it will get a lot of attention in the times to come. Karan earlier made a point and you asked him specifically about tier 2 cities. So, I'm stepping back a bit. I think the reason why tier 1 developers are not going into tier 2 and tier 3 cities is one, there are many successes, there are very few successes and far more failures that have happened in the past. So Nagpur was a failure, Coimbatore was a failure, Visakhapatnam, where HSBC went, was a failure, Jaipur, where I think Deutsche Bank went, was a failure. Not too many people followed, and there were many such examples. The success stories where it did work was Kochi. Calcutta did suffer, but it's now trying to recover. So I think the other reason is most tier 1 developers understand IT better than the commercial real estate market. And I think there's a kind of a hangover of IT on developers. They need to understand and appreciate the opportunity in the corporate space. And I think corporate space is very different in every market. It's very much like residential. So the corporate space demand in Mumbai and Delhi is very different, and the commercial space demand in other cities would be more small scale, medium scale enterprises. And therefore, it's normally being captured by some developers who do build to sell, and therefore they just sell like residential products. So I think that's probably the reason why there's lack of movement. But I think there is institutionalization, and there is an opportunity and more information that will now get harnessed through these vehicles that we're talking about, including SM REITs, will create that pool and attract more institutional players in that market. So I'm sure this will also help educate investors. Although I do have my fears, Abhishek, it requires a lot of discipline. There's a reason why there were certain conditions for REITs. At that time, when we launched REITs in India, people used to talk about markets which failed when it comes to REIT and markets who did well in REITs. And we were not sure. And the reason I think we did well is because there was a lot of discipline. The sponsors are experienced, they understand asset management and their fiduciary responsibility towards retail investor. When it comes to SM REITs and fraction ownership, I think there is not enough maturity, Abhishek, so I'm worried that some bad examples and precedents may actually kill before the opportunity is really realized to its fullest potential.
No, actually very important, Sanjay, and thankfully there hasn't been a rush so far. So maybe both the regulators and the players are thinking hard about it before they come up with an offering. But very valuable suggestions. Gautam, I know at your current strategy, you're not necessarily focusing on the sort of industrial side, but just wanted your perspectives, given how long you've been tracking this space, that while there's obviously a lot of focus on warehousing, the more fundamental core industrial, where I think actually there's a huge opportunity given the manufacturing push, still seems to languish in terms of attention from investors and fund managers.
Actually, I don't think so, Abhishek. In my view, both the the demand and the new supply for industrial, which is, let's say, fueled by manufacturing, and warehousing, which is fueled by consumption, whether it's e-commerce or otherwise, has been are quite parallel, and they both sectors are doing pretty well. It's just that e-commerce, and let's say consumption is required in every city. So you will see absorption and growth happening in all cities across, including tier 2 cities. Whereas industrial backed warehouses are concentrated only in, let's say, the industrial corridors. So, let's say Pune, Chennai, etc. But otherwise, in my view, there is a lot of demand which is coming in for industrial backed warehousing, because these are more long-term contracts and warehouses in which the tenants have done more capex, and hence the tenants are more sticky from that perspective. They're doing more value add operations out of these industrial warehouses rather than the e-commerce or consumption based warehouses. So in my view, actually, and in fact the rent growth also is better in the industrial sector rather than the warehousing sector. So both are doing pretty well.
All right. Kailash, just coming back to you, if you were to write the editorial view on the budget, what are the 2 or 3 points that haven't been spoken of thus far in the panel that you would sort of cover as both hits and misses?
There is enough emphasis that the government has laid on infrastructure development. Also, I think a lot of people have not realized that the announcement was with regards to urban planning. They said TOD policy for any city which has 30 lakh more population. That is the need. I mean, we're seeing already seeing Delhi, Bombay, Bangalore, everywhere, the kind of traffic jams and other infrastructure related issues. Once we have a policy, although this is just the beginning, I guess they'll be developing a policy soon, and then we'll see the implementation and execution actually. But that is a much needed thing, because economic survey also one day prior, they said they're expecting at least 50% of India to be in the cities. So imagine the kind of concerns that we'll be facing if that is the situation, and a good step in that direction to ensure that infrastructure also falls in line with what we're expecting. Also, I think connected to that itself, I think government said they're working on a policy for cities redevelopments. So there'll be a comprehensive plan for most of the cities that are old, to undertake a redevelopment of those, which is needed. And so I think these things, when they fall in place, infrastructure will lead to obviously a good growth for real estate. And I think obviously, given the contribution that real estate has in the GDP growth, we'll see a good amount of support coming from that side.
Great. No, thanks, Kailash. We're on the hour. Vivek, I'll give you the sort of opportunity to make the closing remarks, your views on the unfinished agenda, both from a policy and tax perspective, something that we should put as points to discuss in the next year's panel.
Thanks, Abhishek. And, so I think Budget 24 has been a very positive and a forward-looking one. I think that there is a great boost towards infrastructure development. Just to summarize in the interest of time, I think, like Lata and Arpit mentioned, there's a lot of ground to cover on the debt side in terms of policy and taxes. The debt market for real estate is still it's a core today, but I think because of the taxation and the policies, there's still a lot of slump. The big positive here, I would say, is the angel tax removal. The big negative would be, again, the buyback tax and the, debentures and debt securities being treated as short-term capital gain. That's, I think, a big negative. I think something that could have been more thought through is, the indexation part. They could have maybe let indexation for real estate and maybe remove indexation for other assets. So I think that needs to be a little more reconsidered. So that's my view on the budget, Abhishek.
Thanks, Vivek. I think Sanjay is already walking towards closing his new deal. But before I let you all go, if you all have questions for anyone else on the panel, feel free to ask each other. If not, I'll take this opportunity to thank all of you, Gautam, Arpit, Sanjay, Kailash, Tata, Amit, Gauri, and Karan. Thank you for making time this evening. I'm sure your views were well taken by everyone who was listening in. We'll also put up a recording, and please feel free to share it from your side as well. Thank you again. Look forward to being in touch. Appreciate you making the time. Thanks.
Thank you.
Thank you.
Thanks, Abhishek. Thanks, everyone. Cheers.
Thanks.
Bye.